Bitcoin just broke below $100,000, and the entire crypto market is bleeding red. Ethereum down double digits, altcoins getting crushed, liquidation spiking, headlines screaming panic. But before you hit sell, ask yourself this: is today a moment of temporary fear or the start of a tectonic shift in the global economy? Because what happens next is going to depend on the answer. What's up, family? It's Coach Masi, and you're locked into the Daily Hodl. This is where we break down the biggest financial news, Bitcoin insights, and market trends so you can stay informed, disciplined, and ready for opportunity. Let's dive in. If this breakdown helps you, smash that like button today, subscribe to the channel if you haven't already, and let's get started on some Bitcoin news. And remember, this is not financial advice, this is for educational purposes only. Today's price action is violent for a reason. When Bitcoin slips through key round number support, algorithmic sellers trigger stop losses, leverage positions are liquidated, and market makers widen spreads. That cascade amplifies every tick downward. But there are deeper forces at work. Institutional desks that provide steady bid over the last several months are trimming exposure. Macro funds are reducing risk because of rising real yields and tighter liquidity, and retail sentiment flips fast once fear indexes spike. Put it together and you get a synchronized unwind across exchanges and OTC desks. Data points to watch right now, though: exchange net flows, futures open interest, and on-chain long-term holder activity. If long-term holder supply remains steady, this looks like a supply shock-driven panic. If long-term holders begin distributing, it becomes a structural rotation. Know the difference. And corrections, while they do feel brutal, crashes feel existential, and the difference is all psychology, because we're talking about leverage here. We're talking about margin calls that are creating vicious loops, and we're talking about spillovers that have involved, because today we have a hybrid: retail emotion, it's institutional de-risking, and macro stressors combining. Let me give an example. Look at 2011, 18, 22. Each time the narrative shifted from growth, optimism to fear, flows reversed, and price discovery started again at a lower level. Markets are forward-looking. They price expected earnings, not current headlines. When expected earnings fall, risk assets adjust quickly. Let us be precise. A recession is sustained contraction in economic activity. I want you to understand the common rule of thumb is 2 consecutive quarters of negative GDP, but the lived reality is broader. Falling employment, weaker consumer spending, lower industrial production, and reduced investment. Sound familiar? During a recession, corporations see revenue compression, margin compress, and earnings revisions become the dominant market driver. Stock markets typically lead the economy by 6 to 9 months. That means when stocks fall hard, the economy often follows. But the reverse is true too. Great buying opportunities historically happen when recession fears peaked. So, key market behaviors in recession: rotation to quality, surge to safe haven demand, widening credit spreads, sharp drops that are cyclical, especially when it comes to crypto and drawdowns. They could accelerate and deleverage quickly. You see, millions are also voting today. Policy outcomes from elections influence fiscal stance, regulation, consumer confidence, and even central bank communication. Voter behavior shapes tax policy and stimulus potential, and things are happening because of these elections. Because election results favor expansionary fiscal policy, markets can get a short-term liquidity boost. If results hand power to parties favoring, tighter regulation, liquidity may contract. And that has an impacting effect, especially in the Bitcoin and crypto markets. Now, I'm Bitcoin only, not crypto. But the same goes for, the opposite: pro-innovation. Outcomes can accelerate institutional adoption. So today is not just civic duty, today is market direction. Watch post-election headlines, watch corporate guidance shifts, and watch policy commentary from central banks, because those will determine where this fear wave is fleeing to, or at least part of the macro unwind. So you need a plan. Here are some practical, professional moves to consider, but this is for educational only. Check your liquidity. Ensure 3 to 6 months of cash for living expenses. And high volatility, forced selling is the enemy. Reassess position sizing. Reduce leverage. Volatility is a tax on overexposure. And use dollar cost averaging. If you believe in long-term outcomes, phased buys produce basically timing risk. So monitor objective signals, exchange net flows, future funding rates, and U.S. Treasury yields give real-time clues. So protect your mental capital. Markets will test your psychology. Have a checklist. Have a time horizon for your decisions. And remember, tighten your stops. Reduce the way you bet. Watch correlations. And remember to focus on accumulation strategies. Family, I want to hear from you though. Is today a panic-driven capitulation that creates an accumulation window? Or the start of something deeper, recessionary, pain that drags crypto and stocks lower for months? And how will you vote today? I don't need to know who you're voting for, but I'm just curious. Are you interested in this? If you found value today, hit that like button, subscribe, and we'll see what happens. I know everyone's watching New York, especially right now, but there's so many things going on. Anyways, remember this for education only. That's your Daily Hodl. Stay sharp, stay disciplined, and always lead, pray, hodl. I'll see you on the next one.